What's going on, everybody? Welcome back to the Pipcatcher Expedition Mentorship. So today we're going to be going over factoring in time and price. Without time, price is useless. I want you guys to make sure you guys have your journals, have your notebooks out and shit. I also want you guys to have a pen and get ready to write this stuff down because this is going to be a long one. So be ready, okay? Because this one's going to be a pretty long one for you guys. What is time and price theory? Time and price theory helps us as traders to identify when bullish and bearish order flow will occur, when manipulation will take effect, and refine our edges. This includes quarterly theory and effect, monthly effect, seasonal tendencies, weekly range, daily range, time of day, and 90-minute cycles. Okay? So, basically, we're going to be going over everything that has to do with time inside trading. When we trade, we want to know the time. We want to know how that affects us in the market, right? How that'll affect us and how we trade. We also want to match that up with price, right? So remember last two videos we were learning about PD rates. Those are going to be specific price points that you want to pay attention to. So combining time right now with price. Without time, price is useless. Without price, time is useless. Okay? Make sure you write this down. What kind of trader are you? Are you a position trader? Are you a swing trader? Are you an intraday trader? Are you a scalper? What kind of trader are you? So, position traders usually take trades that'll last, roughly between a month, maybe a week, maybe even on the daily, a daily, weekly, and a monthly time frame. That's the time frames that they trade on. Those are gonna be like the people that are pretty much like investors at that point, early investors, I would say, or investing basically, so like, if you ask your parents, oh, do you invest in any stocks, how long are you going to hold that stock for, is it going to be for a couple of weeks, is it going to be for a couple of months, what kind of investments are you doing? That's pretty much like early investing, which is position trading. Swing trading is basically holding trades for days to weeks, but you're forming those setups on the 1 hour to the 4 hour and the daily time frames. Like position traders, you're holding those trades for, months to maybe even years, but you're forming those setups on the daily, the weekly, and the monthly time frames. As a swing trader, you're holding those trades for days to weeks on end, but you're forming those setups on the hourly, the 4 hour, and the daily time frame. An intraday trader, these are the people that are holding, trades throughout the day or maybe even a couple days, that's an intraday trader, and they're forming those setups on the 1 hour, the 15-minute, and the 4 hour time frame, And a scalper, these are the kind of people that are, holding trades for, less than an hour, maybe 2 hours, and they're forming those setups on the 5-minute, 15-minute, and the 1 hour time frame, maybe even the 1 minute as well. So you need to ask yourself, what kind of trader are you? What kind of trade positions do you put on? Are you able to hold trades? If you see you're going in drawdown, are you gonna get stressed out? Are you able to hold trades and profit until you hit a bigger profit margin? What kind of person are you? As a person, are you someone who's very quick? You get distracted easy. What kind of person are you? Are you patient? It all depends on what kind of trader are you. Whatever trader you are, that's going to be based off of your personality trait. Okay? And you need to decide that for yourself. Intro to quarterly theory. So, quarterly theory is a big bundle of, it's a lot to comprehend. But this is the basis of it, okay? So, markets run on cycles that have 4 quarters each. So if you think about like a fraction of a 4, like a pie, right? You have 4 quarters of a pie, you split it into fourths, right? Each quarter is part of that cycle. Each cycle has a kill zone, which are specific time intervals that give optimal trade entries and a jump in volatility. So these kill zones are the quarters, right? These kill zones are the quarters that you're going to be wanting to focus on, okay? So in these quarters are going to be where your kill zones are usually, and your kill zones are going to be usually between quarter 2 and quarter 3. Those are where your kill zones are going to be. So you're always going to be wanting to focus on quarter 2 and quarter 3 of the cycles, right? This goes from a yearly, a monthly, a weekly, a daily, and then to an intraday cycle level. So these cycles, there are multiple cycles, and they go down in time frames. So there is a yearly cycle, there's a monthly cycle, there's a weekly cycle, there's a daily cycle, and there's an intraday cycle. And these are going to be your 90-minute interval cycles, okay? In these cycles, each quarter is designed to do a specific move. So every cycle, there's going to be a specific move that the market is going to do. And every cycle, that is going to be dedicated to that cycle, okay? So you guys need to pay attention to when the cycles start, when the cycles end. Without knowing this, you are going to be dumb enough to not even comprehend what time it is. And including time into your trading plan. And you guys need to know what time and price theory is, okay? This is time and price theory. You need to include time and price theory. Without time, price doesn't exist. Without price, time doesn't exist, okay? You guys need to use time and price theory to your advantage so that you can understand what market makers, so smart money, right? We want to understand what their goal is, right? And we want to understand the algorithm as well. So understanding this will give us an advantage over the market. Being aware of when the cycles and quarters start to end will bring you to an advantage over the market, okay? So remember, want to understand when it starts, we want to understand when it ends. We also want to understand each cycle that occurs on different time frames, okay? Quarterly effect. So quarterly effect is basically based off of a yearly scale. So this is going to be the yearly cycle, okay? So on the yearly cycle, we have the quarterly effect. So every year there's going to be 4 quarters, and this is going to be split up into a couple months, okay? So each quarter is going to be about 3 months, okay? You divide 12 months by 4, you get 3, okay? So each quarter is 3 months, and this is the yearly cycles, okay? So quarter 1 is going to be January to March. Quarter 2 is April to June. Quarter 3 is July to September. Quarter 4 is October to December. And understanding the quarterly effect will help you understand price on a year-to-year basis, okay? So, understanding these quarters will allow you to comprehend what the market could possibly do during these quarters. Remember what I said, the kill zones are going to be quarter 2 to quarter 3. That is where a lot of volatility might be jumping in. Now, usually in quarter 1 and quarter 2, there's going to be some decent runs on price. Now, we might dump, we might pump. When I say dump, the market's going to slam down. When I say pump, the market's going to rocket. That's what I mean by pumping and dumping, okay? So quarter 1 and quarter 4 are usually when you're going to have your pump and dumps. Quarter 2 and quarter 3, that's when you're going to have the volatility jumping back and forth. And that's where you want to understand what the market is going to be doing during those times. Because that's going to be the quarterly effect kill zones, basically. Okay, so you guys need to understand when these kill zones occur, and you also need to understand when these quarters start and end. Understanding this will bring you to an advantage when we come to the lower time frames. So we need to understand the higher time frame quarterly effect before we even come down to the lower time frame quarterly effect. Seasonal tendencies and monthly effect. Seasonal tendencies are the anticipated reactions of market prices around the same time every year. You can combine this concept with quarterly effect to anticipate how price is going to act during that time of the year. Using this from a yearly basis will bring you to an advantage over the market. So this chart is the US dollar and Canadian dollar. This is a Forex chart, okay? And we'll go over this. You can use stockcharts.com to see seasonal tendencies on any market, okay? So using stockcharts.com, you can see the seasonal tendencies. I forgot to spell out C, but whatever, same thing, okay? So this chart is the Forex chart of the US dollar / Canadian dollar, so USD CAD, okay? So seasonal tendencies are an averaged out span of I don't know, like the last 20 years, okay? So the last 20 years, they give an averaged out span of what the markets do during these months, okay? So like if we look at March, right? We look at January to March. Over the span of the past 20 years, the US dollar and the Canadian dollar pair of Forex, so this specific market, it had always jumped in volatility from January to March, and continuing from March down all the way to September, it had dumped. It had dumped slowly, and then it slowly climbed back up during December. Okay? So, usually that's seasonal tendencies. It's anticipating market movements based off of past data. It's averaged out past data so you can anticipate the market movements based off of the past data being averaged out. You combine this with quarterly effect, understanding the splitting of each quarter. So remember, 3 months is 1 quarter. So January to March, that's first quarter. April to June, that's second quarter. July to September, that's third quarter. October to December, that's fourth quarter. And this is what I was talking about. Between second and third quarter, you're going to have a lot of jumps in volatility here compared to January to March, where you're going to have like a solid little run here. You're going to have a solid little run here. Okay? You're going to have a solid little pump or dump here. A solid little pump or dump there. So anticipating quarterly effect, combining that with seasonal tendencies, that gives you a more, I would say, probable outlook of what you can anticipate the market doing on the higher time frames. Okay? The weekly range. The weekly range is the reactions of each day of the week and the specific moves that it might do during that specific day of the week. Another name for this is called ICT market profiles. We can also use this concept with quarterly theory to give us an improved edge. So quarter 1 would be Monday, quarter 2 would be Tuesday, quarter 3 would be Wednesday, quarter 4 would be Thursday, and Friday would be a separate algorithm which would be down to intraday cycles and 90-minute cycles, okay? So forget Friday for now. We'll go over Friday when it comes to it, okay? But let's focus on the 4 quarters, which is Monday through Thursday. So Monday through Thursday is going to be the 4 quarters that we want to focus on. So combining quarterly theory, remember, quarterly theory is surrounding all of time and price. But getting into the specifics, that's when we need to go into the weekly range, the daily range, and quarterly effect, seasonal tendencies. So going into the specifics and combining that with quarterly theory will give us a higher probability outlook of what the market could be anticipating to do. Okay? So let's start with Monday, okay? So on the weekly range for quarter 1, Monday, right? In this quarter, we will usually have a consolidation or seek and destroy profile during this day. Seek and destroy is when the market algorithm takes out liquidity or stop orders constantly. So if we take a look at this model right here, what is the market doing? It's going up and down, right? It's going up and down, but what do you see about it going up and down? It's going up and down in large ranges, right? Remember what a range is. It's from a low to a high or a high to a low. It's going up and down in large ranges, right? So because it's going up and down in large ranges, what is it doing constantly? It's taking out the equal highs and equal lows. It's taking out engineered liquidity. It's taking out the liquidity that is engineered by the algorithm to be taken out. And what are at these engineered liquidity? It is stop orders. What are stop orders? It is people's stop losses or people's entry orders. And when the market takes it out, it blows it out, as in it stops people out. Remember what happens. Remember what I said when the market stops out people? When you get stopped out, whatever money that you put on that trade, it goes into the market. So when you get stopped out, you become liquidity for other people to use for their orders. Okay? So understanding this kind of market profile, we can take this into consideration of what it could be potentially doing on Mondays. We could take advantage of this and be careful, because once we see this happening, that means we can anticipate that the market might want to be taking out buy stops and sell stops, which are buy side and sell side liquidity. So if the market is targeting buy side and sell side liquidity, that would be the draw on liquidity during those small interval times to be taken out the buy side and sell side. Remember what I said about draw on liquidity? Draw on liquidity means, make sure you guys write this down if you didn't already. Draw on liquidity means where the market wants to go to. Simple. Market wants to go to this, that's the draw on liquidity. Market wants to go to that, that's the draw on liquidity. So remember, draw on liquidity is where the market wants to go to. Weekly range, this is the quarter 2, Tuesday. So Tuesday is always going to be quarter 2. It's never not going to be quarter 2. It's always going to be quarter 2. During this quarter, there will usually be a high or low of the week created. This will be in a formation of price tapping into a PD array on the higher time frames, and creating the lowest or highest price point of the week. Tapping into higher time frame PD rays and or sweeping liquidity on the lower time frames is known as a turtle soup. Okay, so let's take a look at this. Let's say, for example, we have Seek and Destroy Market Profile on Monday, right? On Monday, we have Seek and Destroy Market Profile. We don't tap into that higher time frame PD ray. Tuesday, we tap into that higher time frame PD ray on being bearish for the rest of the week or being bullish for the rest of the week. When we create our high of the week on Tuesday, we are probably and most definitely going to be bearish the rest of the week. When we create our low of the week on Tuesday, we are most definitely and most probably going to be bullish the rest of the week, okay? So this all depends on where we create our higher low of the week, of where we can anticipate the market going the rest of the week, okay? So, a turtle soup, right? Turtle soup is basically sweeping liquidity on the lower time frames, right? So taking out buy stops and sell stops or taking out liquidity on the lower time frames. But on the higher time frames, what we're doing is we are tapping into a higher time frame PD ray. So if we take a look at this model on the right side, we may be sweeping liquidity right here to the sell side, but what we're actually doing is actually tapping into like a weekly fair value gap, a weekly BISI, right? So basically what a turtle soup is, you're tapping into a higher time frame PD ray, but you're sweeping liquidity on the lower time frames. Very simple. Okay. Quarter 3, Wednesday. On Wednesday, there are usually two scenarios that will play out during the daily range. There will be a consolidation to then rally in the opposite continued direction for the week, or 2, there will be a higher low of the week created, then have a reversal in the opposite direction. Okay, so if we take a look at these models, we see Wednesday low of the week here and Wednesday high of the week here. So remember Tuesday, we could have seen that we created a low of the week, but then with the high of the week being created on Wednesday and then coming back down and then reversing, that means the market is going to take out that low of the week that it created on Tuesday, and that would be our draw on liquidity. Same thing on Wednesday low of the week, we created our Tuesday high of the week, traded back down on Tuesday. Wednesday creates our low of the week, starts becoming bullish. That means our high of the week on Tuesday would have been our draw on liquidity after we figured out that the market is going to be bullish. Opposite, we have our Wednesday weekly reversal, right? During our Wednesday weekly reversal, what will usually happen is that on Wednesdays, we will usually be having, remember Seek and Destroy Market Profile, we can have a Seek and Destroy Market Profile taking out buy stops and sell stops constantly to then reverse towards the end of the day. Same thing if we're going to be bullish or bearish, okay? We're usually going to have Seek and Destroy Market Profile and then reverse bullish or bearish. Okay, so we're either going to create our low and high of the week on Wednesday, or we're either going to have a reversal during the week after having consolidation. Okay? Quarter 4, Thursday. During quarter 4, we have a common market profile being a higher low of the week being formed from a continuation from Wednesday. Okay? So usually what will happen is we'll have our continuation from Wednesday. So if we're going to be bearish, like I said, if we see our Tuesday low of the week being created and then we rally on Wednesday and then we see that Wednesday creates our high of the week here, that means Tuesday's low of the week would be our draw on liquidity. So when our draw on liquidity is going to be on Tuesday's low of the week, that means we want to trade below it. And when it trades below it, it's going to create our low of the week. So on Thursday, we're usually going to create our high of the week on Thursday or our low of the week on Thursday. And when we create our higher low of the week, we are usually going to be targeting our higher low of the previous days during the week. So like a Tuesday or maybe even a Monday or a Wednesday. But definitely most not likely a Wednesday, but most likely a Tuesday or a Monday, okay? So on Thursdays, we are usually creating our higher low of the week, okay? And finally, we have Friday. So Friday, we will usually have an algorithm. It's called TGI Friday Market Algorithm. Okay, so during Friday, we will usually have a run, continuation, reversal, or a TGI Friday Market Profile to where we retrace back into 20 to 30% of the weekly range. Okay, so what I mean by 20 to 30% of the weekly range is if we take a look at this model here, if this is Thursdays, right? If this is Thursday, Monday through Thursday, right? This whole range right here, Monday through Thursday. If this is Monday, this is Thursday. If we take this being our range here, 20 to 30% of the range will be here. So what the market algorithm wants to do is it wants to trade back up into 20 to 30% of the range and then close in this range usually. It can go farther if it wants to, it can reject lower, but usually you want to retrace back up into this range and then close somewhere around here. So when the market closes here, that's when we want to see happen for TGI Friday market profile. Otherwise, what we would have been doing is we would retrace back into 20 to 30% of the range and then continue down lower. Or we would just totally reverse and start hitting bullish and closing somewhere inside the range, okay? I know this takes a lot to comprehend, but make sure you guys write this down, because when this comes into the real markets, you guys are going to want to know what this is, okay? So the daily range, okay? We have 4 quarters, we have 4 kill zones, we have 4 cycles. So, in the daily range, there are going to be 4 quarters. These 4 quarters are going to be known as your kill zones. These kill zones are going to be known as your cycles, okay? And these are going to be trickled down into different time frames. So the 4 quarters, right? The 4 quarters are going to be on the daily time. These are going to be your sessions. The 4 kill zones, these are going to be inside of each session. And the 4 cycles, these are going to be inside each kill zone. Okay, so trickle down into time frames. So, the first session is going to be your Asian session. Second session is London session. Third session is New York AM session. And fourth session is New York PM session. And all of these will follow the algorithm, and this is called the power of 3, other known as AMD. And this goes in the order of accumulation, manipulation, and distribution. Now, this is defined based off of liquidity being built up and accumulating, market makers or smart money manipulating traders into getting stopped out to add more liquidity to the market, and distribution, where market makers and smart money put on their real trade and distribute all that liquidity that had been adding up and that had got taken out of the market when traders got stopped out. So you accumulate liquidity, you manipulate into more liquidity, and you distribute all the liquidity. Very simple. So, this is the Asian kill zone, other known as quarter 1. So the Asian Open, any AUD, which is Australian dollar, NZD, New Zealand dollar, and JPY, Japanese yen forex pairs are best to trade during this session. So during this session, any of those pairs, so any currency that has, or any market that has those currencies attached to it, are going to be the best pairs to trade during this time. Why? Because that's where the main currency occurs, and this is where the main time frame occurs, during Asia. So whenever Asian session is open right now, right, those kind of currencies, anywhere where you have a country near Asia, those are going to be the markets that are going to have the most volatility or volume. They're going to be the jumpy ones, and that's when you want to trade those kind of pairs. Okay. The Asian Open can offer trading opportunities based on multiple factors such as bias, higher time frame draw on liquidity, trading model setups, and non-USD paired markets. Okay, so if you're trading any market that is non-USD paired, okay, and you have some type of AUD, NZD, or JPY pair connected to it, that's going to be the pairs that you want to trade. If you're trading a USD pair and it has nothing to do with any of those other pairs, you're going to be consolidating. You're going to be accumulating liquidity here, and you aren't going to have pretty much 0 to none any price action that you're able to take entries or get any trades out of. So whenever Asian session is happening, I suggest you wait for London session or you wait for New York session, because those 2 sessions are going to be the sessions that you're going to be wanting to prioritize. During Asian session, we can use this as an opportunity for us to see the liquidity pools building up. Okay. So USD Forex pairs, indices, and US markets usually will consolidate to accumulate pools of liquidity during this time with low volatility. Okay? So during Asian session, this is where the volatility is going to be low. And this is where you're going to want to wait and you want to anticipate the market either taking out the Asian high or Asian low, which is going to be your buy side and your sell side. Now, Asian high and Asian low is a type of time-based liquidity. So time-based liquidity is buy side and sell side liquidity, but based on a yearly, a monthly, a weekly, a daily, and a session-based scale. So if Asian session is one session, the highest point and the lowest point of that session is known as the Asian high and Asian low. These are going to be some type of buy side and sell side. And not just any type of buy side and sell side. This would be your what? Your time-based liquidity. Okay? So, Asian session is from 6 o'clock p.m. to 12 o'clock a.m. Asian range is from 8 p.m. to 12 o'clock a.m. Asian lunch hour is from 12 a.m. to 2 a.m. Okay? So the Asian range is just another name for the Asian kill zone. So this is the time where the Asian where the Asian session is going to be the most volatile, and that's where you want to put on a trade during that time. Okay? So, remember when I talked about there's 4 quarters, right? There's 4 kill zones and there's 4 cycles. We just went over the quarters, we just went over the kill zone. Now we're going to go over the cycles. So the 4 cycles inside this session is going to be like this. Each cycle, or each quarter of this cycle, is going to be 90 minutes. 90-minute cycles. So each quarter is 90 minutes, and these are known as your 90-minute cycles. And there are 4 90-minute cycles per kill zone session. Okay? So the cycles go like this. Quarter 1 is 6 o'clock p.m. to 7:30 p.m. Quarter 2 is 7:30 p.m. to 9 o'clock p.m. Quarter 3 is 9 o'clock p.m. to 10:30 p.m. And quarter 4 is 10:30 p.m. to 12 p.m. Okay? And make sure you guys write all of this down. So, usually if we're speaking on an indice or a US dollar forex pair, Asian session will usually be your accumulation phase. So remember the power of 3, accumulation, manipulation, distribution. Asian session will usually be your accumulation phase. London kill zone, other known as quarter 2. Okay, so this is going to be the second quarter, and you're going to want to pay attention to this one. Okay, so London Open, the ideal pairs to trade are any EUR and GBP forex pairs. Okay, so EUR is representing the euro, right? The European currency. And GBP is representing the Great British Pound, so England currency. Okay, so any forex pair that has these 2 currencies attached to them, this is the session you're going to want to pay close attention to. Okay, the London Open frequently sets up optimal trade entries, daily range manipulation, other known as the Judas swing moves, and has the highest probability of creating the high or low of the day. Okay? So, London session brings us to having the manipulation phase. So remember, accumulation, manipulation, distribution. We accumulated liquidity in Asian session. Now we're manipulating more liquidity to be taken out of the market and also being put into the market from getting traders stopped out. Okay, so manipulation, this is smart money manipulating traders to getting stopped out of the market. This is manipulating traders to put on stupid trade decisions to get stopped out when the distribution phase happens. And this is just manipulating traders to add more liquidity to the market, period. Okay, this is also known as the Judas swing. Okay, now the Judas swing is a very interesting concept to understand and also learn, because this will happen during manual intervention. Okay, so whenever news events happen, whenever session times open, okay, whenever anything of that sort happens, the Judas swing will happen. And when it happens, it's going to do one of 2 things. It's going to fill liquidity, or it's going to take liquidity. One of the 2. It's going to fill an inefficiency, right? Or it's going to take out buy side or sell side liquidity. One of the 2. And when that happens, you want to anticipate that shit on happening. Okay? London session will create the low of the day when market is primarily bullish, and will create the high of the day when the market is primarily bearish. So during the London session, the market will manipulate, usually creating the manipulation move. And when it creates that manipulation move, it's usually going to be creating the high of the day when we're bearish for the rest of the day, and the low of the day when we're bullish for the rest of the day. Okay? Indices have the possibility to be active during this time as well. So indices, so like the S&P 500 and NASDAQ, they can be active during this time. They have the possibility of having volatility, but it is not the primarily action of those indice markets to have volatility during this time because the stock market is not open. So you usually want to be waiting for New York AM or New York PM session to be happening when trading indices. If you are trading any EU or GBP forex pairs, go for it. This is the session to trade. Okay. We can use Asian session to anticipate London's direction. So remember, Asian session creating liquidity, accumulation. We can anticipate it taking out either the Asian high or Asian low with manipulation. So when we wait for that, that's when we can see a trade forming for us. Okay? Now, London session is from 12 a.m. to 6 a.m. London kill zone open is at 3 a.m. London kill zone is from 2 a.m. to 5 a.m. and London lunch hour is from 5 a.m. to 7 a.m. And I forgot to specify this about the lunch hours. So Asian lunch hour and London lunch hour. Do not trade lunch hour. You don't want to trade during lunch hour. When you trade during lunch hour, it is one of those time frame or time spaces or time periods that you just don't want to bother to trade in. The reason for that is because it's usually going to be a liquidity buildup, and you're gonna get stopped out usually. Okay, so you're gonna have getting stopped out, and you're not gonna have optimal trade entries during that time. Now, the London kill zone open at 3 a.m. This is one of those opens that the market can have the Judas swing. It can manipulate into. So knowing this, you aren't going to get tricked into the market, and you won't get tricked out of the market, which is why knowing when these kill zones happen and when the opens happen, it gives you an advantage. It gives you an edge over the market. Okay, so bringing us to the 90-minute cycles again now. Quarter 1 is 12 a.m. to 1:30 a.m. Quarter 2 is 1:30 a.m. to 3 o'clock a.m. Quarter 3 is 3 o'clock a.m. to 4:30 a.m. And quarter 4 is from 4:30 a.m. to 6 o'clock a.m. Okay? Now, this is where we're going to get into the juicy stuff right here. So New York AM kill zone, other known as quarter 3. So the New York AM open, the ideal pairs to trade are any US dollar or any Canadian dollar pairs, as well as future indices such as NQ and ES. So NQ is NASDAQ futures. ES is S&P 500 futures. New York session would frequently give many optimal trade entries based off of multiple factors such as bias, higher time frame drawn liquidity, trading model entries, and US dollar paired markets. Okay, so this is the kill zone that you want to trade when you're trading indices or any US dollar pairs. This is the session you want to trade. Okay, so during this session, this is where a lot of volatility is going to happen, and also this is where you're going to have the distribution phase or the expansion phase. Okay, so during that's where the market is going to be expanding and distributing all of that liquidity that it built up during accumulation. Is going to distribute all that liquidity that it got manipulated from. So it's going to distribute all the liquidity from the past 2 sessions. Okay. Now, during this session, the market will usually show us an expansion or distribution move for us to identify to enter for optimal trade entries. So when we identify the manipulation phase during London session, we can anticipate the market to continue in the opposite direction of where it manipulated from. So you see in this model up here, we have accumulation here, manipulation to the upside, and distribution to the downside. Where we manipulate during London, we want to trade in the opposite direction during New York. Same thing here, if we were bullish, manipulate to the downside, taking out the Asian low, reversing higher during New York session. So, this is where indices are very active with high volatility. So again, any US dollar pair or any indice, this is the session you want to trade. We can use London to anticipate New York AM's direction. So like I said, wherever the manipulation happens, we can anticipate the opposite direction being favored. Okay? So if we trade higher with manipulation during London session, sell side will be offered to us and to be targeted, which would be the distribution phase to the sell side. Okay? That's it for an example. Okay? So the New York AM session is from 6 a.m. to 12 p.m. New York kill zone for indices is from 8:30 a.m. to 11 a.m. New York open is at 9:30 for indices and 8:30 for forex. New York kill zone for forex is from 7 a.m. to 10 a.m. And New York lunch hour is from 12 p.m. to 1 p.m. And remember, we don't want to trade the lunch hour. So between 12 p.m. and 1 p.m., we don't want to be entering any trades during that time. And bringing us finally to the 90-minute cycles of this session, we have quarter 1, which is 6 a.m. to 7:30 a.m., quarter 2, 7:30 a.m. to 9 a.m., quarter 3, 9 a.m. to 10:30 a.m., and quarter 4, 10:30 a.m. to 12 p.m. Okay? And this is revolving all of the three, remember, accumulation, manipulation, distribution. Knowing these three brings us to an advantage over the market. So we can anticipate the moves that it does based off of the previous session, based off of the volatility, and based off of higher time frame drawn liquidity. Okay? And finally bringing us to the final session of the day, and this is the New York PM kill zone, which is other known as quarter 4. So New York PM open. The ideal pairs to trade are any US dollar and Canadian dollar forex pairs, as well as future indices such as NASDAQ and ES, or NQ and ES. Okay? New York PM session gives the last 2 trading opportunities for the day before closing into the daily range, which will depend on multiple factors such as bias, higher time frame drawn liquidity, trade model entries, and US dollar paired markets. You will typically see a reaccumulation of liquidity or a retracement back into the range from the original distribution leg. New York PM has the possibility to have volatility, but is usually the session to trade when there was no expansion move during the AM session. So, let's dissect this a little bit, okay? So you have accumulation, Asian session, manipulation, London session, distribution, New York AM session. During New York PM session, you will usually have one of two things. You are going to retrace back into the range, right, from the original distribution leg. So distribution leg, okay? So if you look at this here, manipulation leg, distribution leg. So this is the distribution leg. Going up is the distribution leg. What I mean by retracing back into the original distribution leg is we're going to have the distribution leg, and then we're going to retrace, which means come back down into it to close, right? So we have the manipulation leg, distribution leg, and then we retrace back into the range to close, okay? So what I mean by close is, remember the first ever video with this mentorship, I taught you guys the parts of a candle. You have the open, high, low, close. Open, high, low, close. We can line that up with the power of 3. During the open, this is where the candle opens. The daily candle. On the daily candle, this is where the market opens. Okay? We accumulate liquidity here. This is where the open happens. We manipulate down to take out sell side on the lower time frames. But on the higher time frames, we're actually creating our low of the day. Like I said, we create our lower high of the day on London. We then distribute higher with the expansion move, or distributing liquidity here, to then create our high of the day. And then we will retrace back into the range to close into the range. But let's say we didn't create our high of the day yet. Let's say we didn't. What we could possibly do is, instead of retracing back into the range to close, we would retrace back into the range and then continue higher to create our high of the day during PM session. So those are the two examples that would happen during PM session. You'll either retrace to close back in the range, or you either retrace to go higher to create your high of the day. Okay? So, New York PM session is from 12 o'clock PM to 6 o'clock PM. New York PM kill zone is from 1 o'clock PM to 4 o'clock PM. New York PM kill zone is at 1:30 PM. Which brings us to the 90-minute cycles, finally. So, quarter 1, 12 p.m. to 1:30 p.m. Quarter 2, 1:30 p.m. to 3 p.m. Quarter 3, 3 p.m. to 4:30 p.m. And quarter 4, 4:30 p.m. to 6 p.m. Now, make sure you pay attention to open, high, low, close, and power of 3 working together. So you compare this candle, the open, high, low, and close, okay? Or open, low, high, close, whatever. You compare the candle to the power of 3, accumulation, manipulation, distribution. You can see how they both line up with each other, okay? So understanding the power of 3 is factoring in time and price on the lower time frames. Understanding the open, high, low, and close of a candle will dictate you lining up power of 3 with higher time frame analysis, okay? So you need to understand all of these factors. You need to understand the power of 3. You need to understand open, high, low, close. You need to understand the weekly range, the daily range. You need to understand monthly effect. You need to understand quarterly theory. You need to understand the yearly, the monthly, the weekly, the daily. You need to understand all of time and price. Once you understand this and you can comprehend it, then you will come one day, one of these days, when you come to the realization of this and you understand everything, boom, you're gonna realize we're like in a funnel. This market is a funnel. The algorithm is a funnel. It's like the same thing's happening on the lower time frames. It's happening on the higher time frames. So imagine you can trickle down everything that's happening on the yearly basis all the way down to the second. Imagine doing that. You can trickle down everything happening year to year basis from second to second basis. Imagine that. That's insane. That is insane. Which is why understanding time and price is so important to this. Because without time, price doesn't matter. Without price, time doesn't matter. Which is why they both need each other for this market algorithm to work. Okay? So I hope you guys took notes. And I hope you guys paid attention. If you weren't paying attention, you are welcome to watch this video over and over again, as much as you want. But all the knowledge I gave you in this video is going to be useless unless you apply it to the real charts. So soon, we'll get over to the real charts, and I'll show you examples of all of these, okay? And along with this, you guys should be tape reading every night and back testing whatever concepts I show you and give you examples of. You should be back testing and tape reading, which is spotting these concepts over and over again to get familiar with it. And if you don't believe me that these concepts don't work, go look and watch for yourself on the real charts. And also waking up every day to live trade, not giving up, and sticking to it. I hope you guys have a good rest of your day, and I'll talk to you guys later.